Welcome to Your Money Today, a unique look at financial, geopolitical, and other news relevant to you. For 45 years now, your host, Chris Temple, has provided his one-of-a-kind insights and advice on the markets and on our world. Whatever the subject, he calls them like he sees them. Roll up your sleeves with Chris as we get into today's program.
Welcome once again. This is episode 5 of Your Money Today for 2025. The last few weeks we have again substituted my own and some other interviews on other forums. We do that, of course, from time to time, but today's purpose is to recap what's gone on in the markets in recent days. Are we going to go from a correction to some form of bear market? Has this all just been a quick bad dream that's imminently going to go away? What is the Fed going to do about this? And etc. And then speaking of the Fed, of course, we're going to look ahead to the Fed meeting just a little over 48 hours from now as I'm recording this on late Monday morning. And as I always do after the Fed meeting, I'll be visiting with my old friend and colleague Michael Fox of the Prospector podcast, and you'll be getting that recording by sometime this weekend. Now, to start out, we did finally have late last week an official correction where the S&P 500 is concerned. It was down just over 10% from its peak by Thursday of last week. That's the first time since the fall of 2023 that there's been a 10% correction or more in the market. So we were overdue. The NASDAQ at its lowest point was down about 14%. As I'm recording this late in the morning, the market's trying to extend its dead cat bounce from late last week where it was very oversold. But, you know, it's kind of mixed. The Dow was up and the NASDAQ was down last I looked. My view, and I'll give you a spoiler alert right now, is that we're going to have a grinding correction beyond this point, whether we make it all the way down where the S&P 500 is concerned to a 20% or more, at least cyclical bear market remains to be seen. There are more reasons seemingly that we will have one as opposed to not having one, but that remains to unfold. I continue to believe, and we have seen some evidence of this happily in our portfolios recently, that as the market unwinds and a lot of overpriced stocks come back to earth, etc. For example, I heard one comment last week that the Mag 7 has become the Lag 7, that the more overpriced fad stocks of the recent past are going down at a faster rate, as they should. But as that happens, we're going to continue to see pockets where there's actually strength. You know, I've added a few companies recently. I've got a few more coming this week. In fact, for our paid members at the National Investor, I'm going to give you a little bit of a teaser of that at the end. Now, look, even though we're seeing a correction in the market, this does not in and of itself mean that we're going to have a cataclysmic type of event or any such thing. Far from it. Indeed, one of the statistics I heard last week that is, I think, a reason why the Fed is not right away going to react to this, and again, I'll get to them in a few minutes, is that if you look at junk bonds or so-called high-yield bonds, they have actually been flat to slightly higher in 2025 thus far. And that's not usual when you have the beginning of an overall stock market downturn that is based on growing fears of economic weakness, let alone any worries of systemic crises coming, you know, credit crisis or something like that. Because as many of you possibly know already, when it comes to corporate bonds, especially the riskiest ones, they tend to move along with sentiment for the overall economy's health and for the overall stock market. So it's much more normal for the valuations of these high-yield bonds to move with the stock market. And the fact that the S&P is down 10%, the NASDAQ at 14 or so, and yet at the same time high-yield bonds have been treading water for this year, says to me and others that at least to this point, this is more of a repricing of the stock market for what is reality, the reality being that we're likely going to go into some kind of a recession, but that there's still a lot of liquidity out there. The rest of the world's central banks are inflating wildly. China's announced over the weekend that it's going to pull off yet another unprecedented for its stimulus in an attempt to boost consumption in their country. The ECB probably isn't done lowering interest rates yet. They are trying to float a lot of paper, as of course is the Treasury. So I think going forward that the base case, the underlying environment for all of the markets is going to be that the markets stay liquid, which is what the central banks want to see, especially the Fed. And again, I'll get to their outlook and what they're going to do this week toward the end. But it's going to be punctuated by weaker growth. Even with more stimulus coming out, the banks are all going to get less for their money, as will the policymakers. And there's going to be a rotation. So I think this can be as healthy as not as everything starts to unwind. And we're going to have to take it on a sector by sector and sometimes a company by company basis. You know, among the reasons why we have seen a flagging of consumer and investor sentiment, both, I think more so on the consumer front, it's been reflected in the markets. It's been reflected last week in yet another subpar consumer sentiment report, the lowest in a while. You've got a 30-plus year high in forward-looking inflation expectations on the part of consumers. So contrary to the better headline numbers on both CPI and PPI last week, you can't tell Joe Sixpack and Sally Soccer Mom that prices are coming down anytime soon. In fact, they're worried that things are going the other direction. And I think that has skewed some of the business activity a little bit recently as well. It's affected the base metals to some extent. I'm going to get to that toward the end as well when I talked about some sectors we're following and some changes coming to my recommended list for our paid members. But when you wrap it all up, the fact that you've got the economic stats deteriorating and President Trump himself, and among others, his Treasury Secretary Scott Bessent, have pretty much said and admitted that, you know what, this may not be easy to get to the place we need to be. We're unwinding a lot of things. You know, you've heard language used of detox that came from Bessent, that we've got to detox the economy. We've got to get the oversized government spending out of GDP. We've got to go back to a real economy with real numbers and things like that. President Trump has talked about a transition in the economy and so forth. And what's kind of comical about it, and I'm going to get to a couple of specific comments, especially from Bessent in a minute, but it almost sounds to me like this rather infamous crack that came from a fellow named Jack Napier at the movie theater about 35 or so years ago. Jack Napier, of course, the Joker, as wonderfully played by Jack Nicholson. And this is kind of the take, really, that both Trump and Bessent have had in recent days.
You can't make an omelet without breaking some eggs.
So yes, folks, making this beautiful, I should say, MAGA omelet of a better and more streamlined economy, tariffs, all the rest of this stuff, it's going to require breaking some eggs, I guess. And the fact that the Trump administration officials, led by the president himself, are admitting that, shouldn't come as a surprise. And look, you all remember that I said multiple times before the election and before the inauguration and since altogether that whoever won this, and of course when it became clear that Donald Trump was the 47th president, that they were inheriting an accident waiting to happen. We were way out over our skis with stock valuations. We've borrowed a lot of future prosperity by all of the money printing the Fed did and goosing the economy in the wake of COVID, et cetera, et cetera. We all know this already. And so there needs to be a reversion to the mean. There will be a reversion to the mean in many ways, and we are seeing the beginning of that. And again, it doesn't have to be a disaster. And I'm not saying all of this to tell you that I think what the president is doing is wrong. I think a lot of what he says he wants to do is absolutely correct. Now, actions speak louder than words. We're going to get to that in a minute, too, where it concerns the budget and interest rates, because the bond market certainly doesn't believe, by appearances, that the president is going to be able, or really is serious about reining in the deficit sooner rather than later. We'll get to a couple of disingenuous gaslighting type comments that came from Bessent last week on that score. But look, we are overdue for a stock market correction, maybe a cyclical bear market. As we saw a few years ago, we could easily see the S&P drop 20 to 30%, the NASDAQ 30 to 40%. The markets will stay liquid, the world won't end. And hopefully, along with that, we're going to get the prize of a reduced deficit, not an increased one, but we'll see. For present purposes, I think a recession is all but certain, again, simply for gravity's sake, if nothing else. This morning, right before I recorded this, the retail sales numbers came out that were overwhelmingly bad. A couple of exceptions to that, but what were already lousy numbers in January got pared back even more. The Empire State Manufacturing number out this morning was a stinker. That was way worse than expected. This all adds to pretty much unanimous, with a couple exceptions, Dollar General being one. But when you go to the recent comments from places where consumers spend money, everywhere from airlines like Delta to Walmart to Lowe's to Foot Locker, even Costco, we're being told again and again that consumers are pulling in their horns. They're spending less. The checks are less, etc. Now, does this mean that we're going to see a contraction in economic activity when the numbers come out for Q1, which ends just 2 weeks from today? Well, we'll see. A few weeks ago, the Atlanta Fed raised some eyebrows when they predicted that the first quarter would see a contraction of 1.5% in growth. They backed off of that since then. Maybe they're going to go the other direction given this morning's numbers. That we'll see what happens. The Fed again is not going to respond to that right away. But there's a lot of uncertainty, and the reason why there's a lot of uncertainty is that the president, even though there's been what I think has been a very counterproductive and sometimes poorly targeted effort where tariffs are concerned, it's taking a toll on sentiment, on business activity. I've been asked a few times recently if I think it's wise to be getting long again in a more aggressive way where copper is concerned. For instance, copper has rallied very nicely in recent days, contrary to the more subdued economic expectations. We're closing back in on $5 a pound for copper. And it was, some months back that we peaked at like $5.30 or something like that a pound, which at the time was the all-time nominal high price. But we're moving higher again for all of the wrong reasons, in my opinion. And this has to do with tariffs. We've got steel and aluminum tariffs that Trump has actually threatened to increase on Canada beyond the initial announcements. Supposedly some of these other tariffs with them in Mexico are being held in abeyance once again until the 2nd of April, although the president said last week that, look, I'm not threatening, they're going to come about April 2nd. Supposedly this is more of a legal maneuver to not run afoul of the USMCA where Canada and Mexico are concerned. But, I've spoken a number of times to the whole tariff thing. You've heard me say this in great detail going back a few months. And I think the net result is going to be poor economic activity, higher inflation, and the U.S. still not in a significant enough position to be able to do anything about replacing what we're putting tariffs on with our own domestic production nearly fast enough. And I'll just throw this in right now, a subject I'll be talking about more in the near term. It's great when it comes to mining and metals. I'm talking base metals in this context and stuff like that. It's great to have the dynamic duo of Doug Burgum and Chris Wright at Interior and Energy, respectively. Burgum also, of course, being a super czar over a few different cabinet level agencies, plus being on Trump's National Security Council. It's great that we're going to have a much more streamlined regulatory and permitting environment when all is said and done. And it's great that we're going to have the best tailwind policy-wise for extractive industries in the U.S. of my lifetime that's unfolding right now. But that does not change the fact that whereas we have several, and you know what they are, I've talked about them many times, development stage premier nickel projects, for instance, in the U.S., it's great to have them permitted more quickly, but at a global nickel price of $15,000 or $16,000 a ton, not a one of them is going to be financed by anybody with half of a brain because the economics still don't work. You know, copper approaching $5 starts to get to a place where the better projects that are development ready can be financed. But here again, this is not going to be an easy job to replace these things. So, you know, I've said many times that when we go back a few years and it was more acute, that we have started the era of the great stagflation. I think it's going to be a global thing. It already is. It's less bad now than it was a few years ago in the immediate aftermath of all the Fed's money printing, when the headline price increases were 8 and 10%. On consumer and producer prices, but they're still being sticky, and they could easily go the other direction. You know, look at what the president did with these steel and aluminum tariffs, where the cost for the oil patch is concerned. You know, at least some of that steel and aluminum to drill wells and whatnot comes from overseas. And the president just raised the price of that raw material. You know, it's not outlawed paper straws that we put in the ground to suck up oil and gas and natural gas liquids and so forth. It's wells and well casings made with these kind of metals. So you know, this is not going to come off quite as well as has been advertised previously. And I think it's at least somewhat honest on the part of President Trump and some of his people that that's being admitted right now. Now, I mentioned a couple of minutes ago a comment that I want to put some meat on the bones here with especially the Treasury Secretary and his kind of gaslighting us all last week. He gave a rather lengthy interview to Sarah Eisen on CNBC. If you missed that, you can easily go to YouTube, and that's the easiest way to find these things rather than going back and back and back on CNBC's own website. But if you and I'll make sure I find it and put it on the notes here. It'll probably be an abbreviated version of it, but you can go to YouTube and plug it in and usually find those things fairly quickly. But anyways, you know, we just had this, yet again, hand-wringing and exercise and partisan wrangling over what's called a continuing resolution. Because once again, and I've said this all along, I have never liked House Speaker Mike Johnson for this reason, and for what he tried to pull even way back in December by passing a very pork-laden government continuing resolution bill at the time that was pretty much a Democrat bill until Elon Musk led the charge and called him out for it. But this guy has yet to prove that he has the leadership ability or the will to significantly follow the president's so-called MAGA agenda and reduce spending. I mean, we've been treated to this ongoing litany of reports of all of the savings, all of the waste, all of the fraud and so forth that Elon Musk and D.O.G.E have uncovered, all of which I say, huzzah, this is great stuff. It's way overdue, and it only scratches the surface. And yet what we had happen last week, without a peep of complaint from the president, is that for pretty much the rest of the 2025 fiscal year, the government has now said that they're going to spend money very nearly with a fraction difference at the rate of what they spent in the previous fiscal year. What does that tell you? That all of these so-called savings from D.O.G.E, with the House and the Senate passing and the president signing this continuing resolution, they just threw all of that effort and all of those savings away. Now, they claim that between now and the end of the fiscal year in September, when this continuing resolution will run out, that they are finally going to do what not only Johnson, but one or two before him promised. and that is to go back to the traditional separate spending bills for separate agencies, cut what needs to be cut, whether already identified by DOGE or identified in ways still to come, etc. We'll see how serious they are about this. But I'll tell you what, one of the reasons why the Treasury market did not rally more than it has on the stock market getting hammered and all the fear over what's going on with tariffs and so forth is precisely because Trump has not earned the right yet. And this underscores it last week to be taken seriously on someone whose administration and whose policies are going to change the culture in Washington. Of all the things, and those of you who follow me on social media saw me call the president out on this, he attacks Representative Tom Massey from Kentucky, the only Republican to oppose this, and for all the right reasons. And he equates Massey, who is actually the only one taking MAGA and all of the claims seriously instead of playing politics. He equates Massey with a joke and a fraud of a Republican like Lynn Cheney, just because he won't go along with what the president says he wants. If this is how things are going to turn out, then we're going to get to the midterms with a worse deficit than we have right now, with the economy not doing well, nothing to show for all the MAGA stuff, and Republicans will lose, and they will deserve to lose if this is where we go. I hope I'm wrong about this, but we'll see. But, in his interview with Eisen, the Treasury Secretary commented, and I wrote down this quote. I went down and rewound this just to make sure he said the easiest thing when he's questioned, about the deficit and about the continuing resolution and so forth, the easy thing for us to have done would have been to come in and just keep this massive spending level going. Well, that's what you just did. And that's what the president endorsed. At least come out and say, gee, we'd rather not be doing this. We really wish the speaker would do something, instead of, covering politically again, as the president did in December, for a failed House Speaker who has, again, he either has not the talent, the connections, the chops, the will, whatever, to change this spending culture. And in the Senate, it was worse, because Rand Paul, another one, boy, they produce either real great statesmen like Tom Massey or Rand Paul, in this case in Kentucky, Rand Paul, the senator, or stinkers like Mitch McConnell, also from Kentucky, who mercifully will leave Washington at the end of his present term if he makes it that far. But Rand Paul came out and wanted to put the Senate on the spot and see just how serious they are. And he actually introduced an amendment or a separate bill, I forget which one it was, saying, okay, we'll hold our nose and vote for the continuing resolution. We can't stop it, but at least let's enact in law now, legislatively, the cuts to foreign aid that DOGE has already identified. And roughly half of the House, or the Senate rather, Republicans opposed that. So again, you've got a culture in Washington where even with the Republicans, there's just not the ability to do this. So, Bessent, for all of his troubles, fell back on what he calls his 3 Ds as a way that we're going to get this done in the end. His 3 Ds are deregulation. As I said earlier, in the context of metals and so forth, that's great. It's wonderful. I love it. But the deregulation, while good and while it will save businesses some money and reduce some of the fat in government, it's barely a rounding error when you look at overall government spending. The second D is drill, drill baby drill. That is a non-starter, as I've explained many times. The energy industry in this country is not about to fall on its sword, screw its shareholders, and start losing money to increase production, not with prices back down in the mid to upper 60s for oil again. And the third D that Bessent claims is going to help eventually with the deficit and whatnot, DOGE, you just undermined them by supporting this continuing resolution. So we need to see action a lot faster and better than this if we're going to be made to believe that anything is going to change. Because if we don't see this, forget about it. So moving on as we wind down this shorter episode today to the stock market. Bessent, as I alluded to earlier, said, there's a lot of position unwinding where it concerns the stock market. He says, I don't really want to speak to that. If proper policies are put in place, it will lay the groundwork for real income instead of phony income generated by government spending. It will lead to asset gains for the longer term. He also added that if the president's tariff policies work out and we have more domestic manufacturing of different things, these gold cards that the president has been touting, which I think is a wonderful idea. Look, there are ways in which they can move the needle meaningfully in reducing the deficit. I think it's a lark and a fantasy that they can eliminate it by the time the president's 4-year term is over. But if they do it, God bless them. But they just threw away year one. Okay, that's what they did in supporting this continuing resolution and increasing the debt ceiling and all that through September, which is the end of the fiscal year. So when we're going to get to September and the deficit for this fiscal year is going to be as high or higher than it was for Biden in his last year, that's not going to look real well. And that's, again, the reason why the bond market's not going to give the president a whole lot of help right now. It's going to be very, very difficult for the president to get this big, beautiful bill that he wants, all the tax provisions he wants, and things like this, as half of the Republican senators have already shown. They want the U.S. to stay a global empire when it comes to being able to use money as a means for either laundering or leverage where other countries are concerned, and that's a sad fact. So the president, though he does not have the kind of overt opposition from Republicans and never Trumpers that he did in his first term, thankfully, he's still got this culture that even he is going to have a hard time changing. I hope he does it. I wish him well. I have all along, but that's where we're at. And moving on to a couple of things as we end. First of all, the Fed Wednesday afternoon will announce, I think, unless I'm all wet, and I don't think I am, that they are going to stand pat on interest rates. Powell will be pressing his press conference as to why they're sitting on their hands when inflation has softened a little bit last week, though the year-over-year numbers are still too high. I'm sure he'll point that out. But he's going to, again, use the president and tariff policy as an excuse to stay where they're at right now. He will repeat what he did the last time if the question comes up, which it probably will, that corrections come and go in the stock market. It's nothing to wring your hands or fret over. And as long as the markets are functioning okay, which they certainly are, just an overdue correction in the stock market's not going to make a move either. So what will be interesting to see is if he throws those pining for more Fed rate cutting a bone in any way at all. Will they show that there's more Fed voting members this year that think that maybe we'll get more than 2 rate cuts in 2025. Don't forget that at the end of last year, the consensus was that there would be 4 rate cuts of the equivalent of 25 basis points each in 2025. Then they went to 2 because of sticky inflation and all the uncertainty over the Trump's policies. I think if the consensus were to stay at 2, after Wednesday's meeting, that would resume the stock market correction. If you get a few outlooks change and the mean case is for perhaps now up to 3 again, rate cuts for 2025, maybe we'll have a bit more of a chance for a near-term bottom for the stock market, though it's still my view that we're going to continue to ratchet down. So we'll see what happens with that. And again, I will be visiting with Mike Fox right after the Fed meeting. We're going to record a podcast early on Thursday, and you'll see that by the weekend. Last but not least, moving on, as I alluded to earlier, the market repricing is going to have some good benefits. I think that energy, generally speaking, and I specifically include uranium in energy, where the sell-off in uranium and uranium stocks is really, really a gift to long-term investors again. So we're going to be taking some increased and a couple of new positions in the uranium and nuclear energy space imminently. Old energy, oil and natural gas, I think that it's a little bit dicey right now. I have been encouraged by how well the pipelines and the dividend-paying companies have held up. But the E&P companies, I think, have been beaten up, especially the Canadian ones. You know, we're kind of hostage there to politics, to the tariff policies, and we still have not received a definitive word yet, where Canada specifically is concerned, as to whether Mark Carney is going to immediately agree to elections, which if he does it fast enough could be, late May, early June, or if they're going to kick the can down the road and he tries to stay in there on behalf of the Liberals, and we're going to have to go till the fall. So you friends of mine in Canada, see what you can do about making it sooner rather than later, because I continue to believe with all of my heart, despite the fact that the Liberals have held on to power up there to this point, and despite the way in which President Trump has regrettably muddied the waters and caused problems with a great ally that the U.S. has in Canada, from whom we import 4.5 million barrels a day of oil that we cannot replace anytime real soon. I still tend to believe that Canadian energy is screaming by long term. The problem is we've got to get over this near-term uncertainty, hopefully, for everybody's sake, not in a way that sees a longer rift between the U.S. and Canada going the route of deciding, and there's talk about this, even among Premier Daniel Smith in Alberta, that this may be necessary. He said, well, we need to get a new government in Canada to, accelerate pipelines so that we can sell our oil and gas to other foreign buyers if the U.S. doesn't want them. That'd be a shame for a lot of different reasons. But anyway, I think that energy we got to be more selective about. Uranium is a table-pounding shout from the rooftops, buy again, because this is still the single best long-term secular story for any metal, commodity, energy, or whatnot that you can look at. Over the weekend, you probably already saw that I did an updated interview with one of our covered companies, Borealis Mining. Some very interesting comments in there about gold hitting 3,000 an ounce last week, kind of tickling that number again this morning. But more so as to the durability of this, make sure you listen to what Kelly Malcolm, Borealis' CEO, brought up and my response to that, because it tells you a lot about just how much farther this gold market probably has to go. Last but not least, our members first are going to see a new or renewed theme and a couple initial recommendations in this area on technology issues, more so how to protect businesses, your personal data, and so forth today from the newest generation of hackers out there that are using the early stages of quantum computing for very nefarious purposes. One of the working titles I have for a special issue I'm going to be doing is From Y2K to Y2Q, to Quantum Menace, Q of course meaning quantum. We all remember, or many of us do at least, what happened back in 1998, 99, the legitimate concerns that a lot of us had back there about what might befall the world, business, our bank accounts, everything from the so-called Y2K computer crisis, which was nothing compared to what we have today with quantum computing and the new quantum menace, where there are many ways in which hackers today, now more than doing this as a business, are able to infiltrate your data, sometimes without you even knowing it, sometimes even if the data is not presently useful to them, but will be later. Those are handle attacks I'm going to be talking about. There are things we need to prepare for here, but there are also glorious investment opportunities from a few software companies I've been researching in recent weeks, and our members are going to start hearing about them imminently. So if you're not already a paid member of the National Investor, make sure you go to nationalinvestor.com and click on subscribe or renew. So that's it for today, and I'll be looking forward to being back with you by the weekend when I visit with Mike Fox on his Prospector News podcast.
We're glad you joined us today. As always, write to chris@nationalinvestor.com with your comments and questions. And be sure to visit yourmoneytoday.org if you haven't already. Sign up for our free alerts, notifications of new shows, and more. Thanks for tuning in, and we'll see you next time.